So let us start with our next fireside chat with one of the most eminent economists in India, whose views and analysis are something every market participant watches out for. So ladies and gentlemen, please welcome Mr. Soumya Kanti Ghosh, Group Chief Economic Advisor to State Bank of India. He is also a member governing board at IICA. For 5 successive years ending 2022, Dr. Ghosh has been ranked as one of the best individuals in research in India by the Asset magazine. He will be sharing his views and insights on the world ahead. Are the changing geopolitical equations and macroeconomic indicators reshaping the global economy? Mr. Ashank Desai, founder and former chairman Mastek, and founding member and former president NASSCOM, and also a member to our advisory board, would be moderating the session. Requesting Ashank sir and Soumya sir to please come on stage. A huge round of applause for our panelists. Everyone. Thank you so much for joining us today. Ashank sir, over to you.
Thank you, Mansi. We have, of course, a session timing which is not the best all the time, as all of you know, with a nice lunch that all of you had. But the subject is so interesting, as someone said, we'll keep all of you shaking with the thoughts. So thanks, sir, for coming. Very nice to. We have many of my audience also would have heard you on CNBC and your economic views. But I think this is a forum, as I said yesterday, is about venture capital, entrepreneurs, investor community. And although many of the entrepreneurs, and I have been many years ago and still, say, how does economy affect me? I'm only worried about my small sector. I'm a very small guy. How does the economy, something happens in 1 trillion, 3 trillion, doesn't matter me. And that's where I have seen my sales guy making mistakes all the time. Economy sends strong signals, if it is going positive or negative, to whole nation, which in turn affects moods of every sector. Some of them more, some of them less. And then it affects all of us. So in a way, we may think economic growth and numbers are far away from us, but they are very much grounded as far as your day-to-day business goes. So I will just start with immediate question, which most of us have. Given our first quarter results of GDP, which was below the expectations, as you know, what is your cut on economic growth this year? Do you think we will cross 7 or will be below 7, or is it something going to be more or less? Either way, maybe I'd like to start with a straightforward question.
Okay, thank you, and thank you for inviting me over here to speak. I know this session after lunch is always very difficult. So since I had to speak, I had taken a little bit of lunch so that I can speak more and think. Coming back to the point of this GDP growth rate, I think let us put some of the things in proper perspective. In first quarter GDP growth rate, came in at 13.5%. That was lower than the market expectations. In fact, our estimates also were significantly higher. But we need to drill down and understand some of the simple things. I will explain it very simple methodology. I think in second quarter of the calendar year, which is basically the May to April to June quarter, the global GDP growth rate of 20 economies were 4.9%. So India at 13.5% is 2.8 times more than that at the global average. However, that doesn't mean that India has done remarkably well, but the point to note over here is that the first quarter growth rate in very simple terms and layman terms is basically a completely statistical artifact. What has happened is that there are three segments of the economy: agricultural, manufacturing and services. Agricultural and services sector has done very well, and they are almost in line with the expectations of the market consensus. What has disappointed us is the manufacturing sector, but the growth rate in the manufacturing sector is actually a statistical artifact. Why I will explain is to that, you know, there is a concept in economics which is called gross value added, which is basically you add the EBITDA margins and the employee cost. Now, what has happened is that because of the prolonged conflict, the margins of the corporates have taken a significant hit. They have now declined to levels of pre-COVID, FY19 first quarter. So if the margins decline, obviously the gross value added will decline, and that has exactly the results. The second thing is that the corporate profitability has also grown at a modest rate. What has happened is that, again, this is a statistical artifact, is that if you look into the all quarters corporate profitability, the quarter where India witnessed a lockdown, that was in April to June 2020. And if you take the growth rate of April to June 2021 over 2020, that growth rate statistically came in at more than 10,000%. So because there was no profitability in the April to June quarter. So when you are looking into the April to June 2022 also, that growth rate is only 11%. So again, it's a statistical artifact which has somehow pushed down the growth of the manufacturing. And finally, I'll just kick this debate, because we have been talking about this for a long time. I think the manufacturing data which the CSO measures in the Indian context is hopelessly backdated. We have a 2012 basket of IIP, which had companies like Nokia, which used to produce cell phones. They are still there in the basket. And India is now exporting handset exports. Foxconn and Apple, Foxconn has already set up manufacturing facility, and iPhones will be produced from here. Do you know that this handmade exports is not a part of the IIP basket? So whatever changes we are doing in the manufacturing sector, the government has been trying to do in the last 3 years, they are not adequately represented. And as long as this is not corrected, I am sorry to say that this growth rate will be a true reflection of whatever manufacturing capability we have.
Thanks. So I think those B2B business entrepreneurs here need not worry, though manufacturing numbers may not look right. That's what you are saying. Interesting. So let me jump to real, what I would say, big dream question, and which is where all of us here looking forward to our opportunities and growth, and that's what all entrepreneurs do, and that's why they are in business. So in the morning we discussed, and I think all of us are discussing in this Amrut Kal, we have to head for 24 trillion GDP in next 20-25 years. Some of it, or most of it, requires a growth rate of at least 10% for at least next 7, 8, 9 years, 10 years. Maybe it can't be sustained forever. We have seen China could do it only for 10 years. You, as an economist, having seen the economy, having seen all the aspects of it, what is that constrains us, according to you, in terms of achieving 10% growth? And related to it, all of us here are technology guys in a way. Half of the IvyCap today funding is for the IT related. Although they are D2C businesses, but they use IT and technology. What role technology can play to make that happen too? Both. One is generally what is the constraints and what prevents us, and other is the role technologies can play make to happen.
Okay, I think it's a very interesting question. There are many facets and many answers to this question, so I'll try to brief and cover as many points. The first thing is that I think we need to temper down our expectations. 10% growth rate is going to be very difficult, and I'll be very surprised if India achieves that 10% growth rate at any point of time. There could be sector-specific growth rates, but overall, I think the new normal could be an sub 7% growth rate. But the important point to that, if you actually look into the data of the China from 2016 till 2021, China's growth rate actually has been hovering in the range of 6 to 7%, and this year, this growth rate could be significantly lower than India. So that means that the expectations is to be tempered, a sub 7% growth rate, even if you grow at say 6.5 to 7% continuously for a period of say 7 to 8 years, I think that is not a bad achievement. So the first thing. The second thing is that what are the things, important things which basically has happened? I'll tell you, I think, in terms of, I'll talk first about technology. I think, because you spoke about Amrit Kal, I think the maximum technological change, and that's a behavioral shift on the part of the public, which has happened in the last 3 to few years. If I put some data in the perspective, the total UPI transactions compounded annual growth rate in value and volume terms has been 330% in the last 5 years. So that's one of the achievements. The second thing is that as India becomes more and more technology savvy, I think there is a revolution and a structural transformation which is happening in the financial services sector. All of you know about Bill Gates, that the banking is not banking. Banking as a service model. So I think progressively this technological transformation which the fintechs are doing and the banking sector is doing along with the fintechs are actually leading us to that path. I will recall one shareholder address by the JP Morgan head Jamie Dimon in 2021. If any of you has gone through that, you will find that he talks so much about the fintech sector and saying that the challenges for the banking regulation is how do you regulate this entire massive transformational change. For example, if I look into Walmart, every day around, I think, 200 million customers get into Walmart every week. We have Apple Card. Then we have also some sectors like Vanguard, then which are not even, which also do these services, but not even counted. Last year, the total amount of money invested in the fintech sector, if I am correct, was around 130 billion. And these fintech companies, and in fact, all these major companies which I am talking about, this Apple, this Vanguard, these the other players, they do a lot of buy now, pay later, credit risk assessment, merchant acquiring business, then all sorts of business they do. So I think in future point of time, what is going to be important for the banking sector is that this banking sector behemoth and the fintechs and all these players working together to bring about a structural revolution in the lending of the country. Our bank, for example, today we have an app of Yono, which makes one get a loan in 2 minutes or 3 minutes. And my sense is that over the next 20 to 25 years, all this loan and everything will become cash flow based lending. If you have the cash, you can get the loan immediately. Today, the credit to deposit ratio in the banking system is less than 70%. We did a recent simulation that we may not be alive by 2047, but in 2047, what could be the credit to deposit ratio? We found out that the credit to credit numbers could be, and deposit numbers could be around 155 lakh crores from the current level of 105 to 110 lakh crores, and the credit deposit ratio could be as high as 80 to 90%. So if that is the level which we are trying to achieve, and this is the structural changes which is happening in the banking sector. At the banking sector, we need to understand that banks, the fintech, all these players will work together to make this happen. And I don't see any reason why it is not happening, because today every opportunities, co-lending opportunities, banks are exploring with NBFC. Agricultural sector banks are trying to capture the entire agricultural value chain. And at the end of the day, I think, the idea is that we need not go to the bank. The banks could actually get all the service on the tip of a button. So this is one aspect. And finally, the other thing is that when I was talking about this 10%, couple of things came to my mind, and I will mention this in, I think I'll take a minute. I think the global economy has undergone structural changes since the Ukraine war broke out. I remember, I think, just 2 days back, there was a news item in the newspaper that UK is actually freezing the bill for all its consumers as $2,500 per $2,500 for energy bill. What has happened is that this Gazprom, this gas connection which the Russia goes, the Germany, without, I mean, trying to blame anyone, 2006 to 2022, I think, and this after this Gazprom facility was opened, I think there has been no development of the LNG terminal from whereby this liquefied gas could have come from places like Qatar and even USA. So that was, I think, one of the reasons that these countries may have missed. Yesterday I saw another news item that India is now speaking closely to Russia that they can actually supply the Gazprom, can supply them gas to us. India is already buying oil, which is at which is 12% of its basket. So I think perhaps India has been able to take advantage of the war in a significant way. The Indian rupee, we can come to that. The Indian rupee, the performance has been one of the best ever. And today, these companies which we call, if you look into the capital flows into the system, the portfolio, the capital which is coming into the system, 75 billion is the amount of money with these US companies which we call the blank check business companies. They are ready to invest. So, and given the fact that India's weight in the MSCI index has moved up now, just replacing Taiwan, I think there is no other reason that why India can be a beneficiary to all this development. So all in all, I think things have changed, and perhaps the war which has worked in advantage of India, and I have never seen that even after the dollar recouping to 20-year high, the rupee has still been holding below 80 against the dollar. By this current logic, the rupee should have been at much higher levels, what we could have thought of.
So your thing is that it would have gone even above 80 had it not been for some of the collateral benefits of the war.
If you do a very simple estimate, what basically you look into the dollar strengthening from say March 2021 till date, which is I think close to 20%. You look at the rupee depreciation from March 21, so it is actually around 8%. Ideally, if the rupee depreciation is lower than the dollar strengthening, that means that the rupee weakening is purely because of the strengthening of the dollar and nothing else. And that is exactly which has happened. Apart from the Indonesian currency, Indian currency is perhaps at the second most rung if you compare all the depreciation from over this time period.
So on the lighter side, that means if war stops, we have to worry about rupee, is it? on the lighter side, but that apart. So coming back to that 10% growth rate question, you think that's a challenge which is not going to be easy to achieve. And if that be the case, we are $25 trillion could be a question mark. Is that what you are saying? Let me ask you a controversial question.
So basically the point is that yes, if you ask me 10% growth, I can say that 10% growth cannot be the new norm in a country which is actually becoming decoupled, significantly decoupled. The good thing is that the trade has not deteriorated from 2020-22. Trade, global trade has continued to be buoyant, and India has been a beneficiary of the buoyant global trade. Last year, our total trade and services export around 670 billion. So I think the idea is that in India, in the employment context, if you ask me, overall employment pattern in the Indian context, you will see a large part of the startup revolution which is now happening in India. I think a large part of the Indian labor force is actually, you can say, they have an own employment. So from that point of view, while it is true that a higher amount of growth rate could be required to absorb the growing amount of labor coming into the system. But if you actually look into the India structure of the labor force, a large part of it is already, they are self-employed, and possibly this revolution which has happened, this startup revolution, 55,000 startups which has happened in the last couple of years, this could actually give a new impetus to that system. So my sense is that, and for India, the issue in fact, the US is also facing the same issue today after pandemic, is that underemployment is the issue. Unemployment in the Indian context, there are a lot of debates I don't get into, but my basic idea is that India faces more of underemployment than unemployment.
Okay, thanks. Coming back now, back to the near home or near time frames, over next 2-3 years, how do you see whole this thing panning out? High inflation rates continuing in developed world, in India maybe less, but still higher than what we aspire to. Interest rate observation, of course, will impact many of our fintech and others also. So how do you see people talk of stagflation in developed world at least? How do we put all these three things together and make some prediction of next 3 years?
So I think, again, it's a very interesting question. I think there are two parts to this issue. I think if you look at the developed countries' inflation and the developing country inflation, the developed countries' inflation actually, I think the worst is not yet over. What these countries are doing is that their countries are now trying to subsidize the energy bill. I'm not blaming them, but the byproduct of this could be again significant pressure on the fiscal, and that could actually have a second round impact on the inflation. US is finally getting a grip on the inflation. The US inflation is likely to decline. So that's one thing. But the US has been from 2008, their motto was to get to a 2% inflation target. They could not do it for I think 13 years. But in 1 year, they actually undone whatever they had tried to do in the 13 years, because inflation rate has moved up to 9-10%. And I think it was whatever is that. I don't want to get into the discussion of Fed, but Fed may have delayed the rate hikes. But for the Indian context, I think the low interest rate, which you have witnessed during the pandemic, has resulted in some behavioral shift on the top part of the households, I think, which is very good for us. For example, if you look into the stock markets today, I mean, look into the stock markets. The US is raising rates. India, in August, there was a portfolio capital inflows. July 29 till September 10, the capital inflows in the Indian context was around 8 billion. So I think no amount of economics justifies that why is capital flowing into an emerging country. The only factor which I can say it's a TINA factor, because economics, everything is relative, everything is doing badly, but India is doing perhaps much better than other countries, the capital is flowing. So this is perhaps something, this normal, even economics cannot explain why it is, because crude at such high levels, the first thing. The second thing is that the household behavior in the financial markets have become a self-fulfilling prophecy. They know that bank deposit rates have been at low levels. The bank deposit rates basically are still taxable of less than 5 years. And given the fact that if you put money in stock markets, if it gives you a reasonable and assured rate of return, that's why today we have already reached the landmark of 10 crore demat accounts. The household investment in mutual fund and equities in the Indian context, I don't have the number done. 2021 number was around 2.5 or maybe around 3 lakh crores. In USA, this number is more than 300 lakh crores. So there is a significant upside to this, which investment in the financial market can happen. And it is a fact that the households actually has been holding the stock market at these levels, even though there has been massive sell-offs by the portfolio institutional investors in the last 6 to 7 months. So this talks about the new faith, they believe in new avenues of investment. And at the end of the day, it is also good for all of us, because it leads to deleveraging, it leads to the corporates actually able to raise a lot of equities, IPO, and they are becoming debt-free, which makes it imperative for a new set of investment revival, which is, I think, round the corner, given the capacity utilization is there at 75%.
You are positive in terms of as
so
we go ahead.
All these things actually makes the story very largely positive in the Indian context, and I think there are reasons to believe, because it is very difficult to explain that why there was such a capital inflow into a country like India, and why the markets are continuing to do so well, even as there has been a meltdown in the global markets. Of course, there is a volatility, but I think it is still difficult to fathom all these changes.
This China plus one factor maybe also could be one of the reasons probably.
Yes. China actually, I think this I think is a very important. The China property market is in the throes of a massive sell-off, the construction sector. It has been witnessing the property sales has in China is now declining for the last 11 months in a row. Since 1990, when China developed this private property market, it has never seen such a significant amount of sell-off. And China is basically getting Japanified. So basically, with an aging population, the construction sector is unlikely to do well in China. And India's April to June property sales were 60% higher than April to June last year. So we have a country which is young, property sales are at 60%. You are a country where the property sales are 11-year low. And also, given the skirmishes with the US, all these companies are getting delisted from the China Stock Exchange. I think that's also a matter of opportunity for Indian companies to go abroad and tap the markets.
Okay, I think time is running out, but to be fair to the audience, is there any one question you have? I'll entertain only one. Should be short. We don't want long question. Just ask straightforward, quick question, just to be. So before I summarize quickly.
As you know, People's Bank of China has frozen the deposits and all. So can there be a ripple effect of that and take India also into its own downpath?
Okay, got the question, yeah.
No, I don't. So no, I don't think there will be ripple effect, because if it had happened, it would have happened last time, because the Evergrande crisis actually happened 1 year back. Since then, there has been a spate of problems in the China construction sector. And my sense is that these changes in the China's demographic population structure, problem with the Chinese tech companies, problem with the Chinese aging population, and I think all this is going to play to the advantage of India in the next. Please remember that China growth rate has been slowing from 2016 onwards.
Okay, so thanks, Dr. Soumya Kanti Ghosh. I think I'll summarize it quickly saying that next 4 or 5 years, of course, look very good compared to the other global economies. That's a good news for all of you entrepreneurs who are doing business in India. But I think you people will have to work hard and make technology more successful to reach 25 trillion number or 10% economic growth rate. Hopefully we can do that, or even with lesser, maybe we'll achieve that. But I think the bright future is ahead, is a positive signal that I take from you.
I just want to add one point before I get up. I think in the real estate sector today, the most interesting changes which is happening is that the first time women borrowers in tier 3 and tier 4 cities is growing at 23 to 24%. So this is something of a revolution which India has not seen in the last several years.
Thanks for your comments. Confidence building exercise for all of us. And thanks for coming.
Yes. Thank you so much, sir, for such an insightful discussion. May I please request Sonia to hand over the token of appreciation, and also if we can have a photograph. Thank you so much, Soumya sir, for giving us your time, and thank you so much, Ashank sir.